I need some traction. You need some traction.
Welcome. As you're joining us, please feel free to add your name into the chat. Let us know where you are tuning in from. And Jordan, tell us where you're tuning in from today.
I'm in beautiful New Jersey today.
Beautiful New Jersey.
South of the border, and yeah, not too far outside New York City. So one of the suburbs of the city.
Amazing. And what about you, Alex?
Beautiful Vancouver. Nice and sunny today.
You actually mean that though when you say beautiful Vancouver.
I mean it, yeah.
That's actually true.
Yeah, I love it.
It's been an awesome winter so far, so no complaints.
And it looks like Russell's tuning in from Austin, Texas. And as you're joining, please feel free to say hi. I'm going to go ahead and get us started. My name is Erin Blasky. I'm a fractional CMO to startups and scale-ups. And I've been doing this for about 20 years now. So today's session is going to be on capital efficient ways to go from $0 to $10+ million. I know I'm pretty excited to hear about what both Jordan and Alex have to say about this topic. So a bit of housekeeping before we start. Today's chat will be recorded, and we'll post that to the Traction YouTube channel and the Boast.AI website probably within the next week or so. And as I already mentioned, the chat is there. So as you're tuning in, I can see we've got Dan from Lansing, Jonathan from Austin. So welcome, everyone. Please say hi. Let us know where you're tuning in from. We also have a Q&A box, which you can navigate to. That's the best place to put your questions. So if you have questions for both Jordan and Alex, please put them in there and we'll be tuning in. Looks like we've got a couple others: Sonoma, California, Calgary, Vancouver, Edmonton, LA. Wow, there's a lot of representation across North America. Jordan, Alex, I don't know if you both can see the chat as well.
Again, I had somebody from Egypt. That's
Yeah.
we're going far and wide.
Pretty amazing. Before we dive in, I'm going to tell you just a little bit about Boast.AI. So Boast is on a mission to help innovative companies become successful by democratizing access to billions in R&D tax credits, innovation incentives, and non-dilutive capital to companies that can so that companies can fuel their growth while preserving equity and avoiding red tape, which is something I know everybody wants to do. So to further its mission, Boast also co-founded and built this nonprofit traction community to over 90,000 entrepreneurs and technology professionals. And it's honestly an incredible community, an incredible platform, and Traction provides free access to resources and advice on building and scaling companies. So the company, Boast, bootstrapped to 8 figures in revenue before securing $123 million in funding. And maybe just do a virtual round of applause for that, because that is a pretty incredible feat to do, and congratulations. So today we are very excited to be speaking with Boast's co-founder, Alex, as well as Jordan Bettman, the founder and managing partner at Radian Capital, which is a New York-based growth stage fund that invests in capital efficient companies. So I know I've already said welcome to both of you, but Jordan, I'm going to start with you. Why don't you just introduce us a little bit, to Radian, and tell us a little bit more about what you do?
Yeah, absolutely. Thanks again for having me. The only thing I did was write a check into an awesome company. So this is like the gift that keeps on giving. I am one of the 2 co-founders of Radian Capital. We are a growth stage focused, we consider a growth equity firm, but it's, really is a perfect hybrid of venture capital and private equity. We very much seek out companies exactly like Boast. We look to invest in businesses that are 5 million plus of ARR, or some version of top line revenue, that have done it lightly capitalized or bootstrapped. So we really care quite a bit about capital efficiency. We are not your prototypical venture fund. And in saying that, we're able to build a platform, and we have built a platform. My co-founder and I have been at this about 5 years. Both of us were previously partners at Bain Capital Ventures. We've been at this about 5 years, and we really build Radian on 3 very simple premises. One is we believe incredibly deeply in high conviction, high concentration investing. So in each of our funds, we invest in usually 8 to 10 companies. And for anyone who knows, the GP world, the investment world well, the prototypical venture fund probably has somewhere between 30 and 40 investments in each of their fund. And for us, we think it's a really important distinction, because when we look to partner with companies, we really focus on that word partner through and through. And if I have 40 investments and you have your N of one, your blood, sweat, and tears in your company, we are not aligned. If I have 40, then I'm going to do some things or push you to do some things that are maybe unnatural to you in the hopes that you survive it and thrive from it and get to be a, very large size business. And the only cost to me is if you don't, maybe it doesn't work out for you, but then I have 39 other investments to work on. Whereas we as Radian, it's not our N of one. We like to say entrepreneurs N of one, but 8 to 10 deals in a fund is very concentrated. And by doing that, we think we're aligned. And what we try to do is we try to push entrepreneurs and companies to be the best version of themselves, but no more, no less. So because somebody else is growing faster or doing something different or burning more money, like that's the right thing for them. But for you, it's how do we make you the best version of yourself? And again, we're very aligned in seeing that through at all kind of stages of outcomes. So I think that's pillar one. The second thing is, second and third kind of go hand in hand, particularly in 2021, everyone sees what's happening in the markets. Investors, capital is a commodity. For companies that really need it, it may be hard to get, but for a lot of the best companies in the world, capital is a commodity. If you're going to sell a commoditized product, you got to really think about wrapping the right goods and services around it. And so for us, we care very deeply about sector expertise. So I was just joking with Alex. I'm by no means a tax expert the way Alex is, but I have spent 15 years focused on selling software to CFOs. And so understanding the different pain points and needs and budgets that different CFOs have, and things more tactically like just a very large Rolodex of CFOs at medium and larger companies that Alex and the Boast team should be talking to or selling to, and channel partners, advisors, et cetera. That all goes a long way. And then we have a bunch of full-time operating partners on our team that work very closely with the companies that we invest in to be extra arms and legs to help them. We have more people on the Radian team than we do portfolio companies today. So again, it comes back to that concentration piece. If I have 100 portfolio companies, then it wouldn't really be credible to say my team can help you. But in Alex's case, and he could speak to it probably even more than I can, whether it's strategic questions, tactical questions, he knows we have a bunch of functional experts on our team that will be there to help him through all the trials and tribulations that we will go through together. And so putting that all together, that is Radian Capital. We're currently investing out of a $315 million USD fund. We write checks as small as 10 and checks as large as 60 million of USD. And like I said, we really look to concentrate and to partner with the best entrepreneurs doing the most interesting things with their businesses.
That's awesome. And you mentioned at the very beginning that you wrote a check that keeps on giving, or the gift that keeps on giving.
Yes.
So maybe tell us a little bit about how you actually found Boast and what made you invest in them.
Yeah, but these guys in particular, not only are they unbelievably talented co-founders, Alex, who's on this video conference call, and Lloyd as well, but they're also the co-founders of the Traction Conference, which brings us this conversation today. And just the sort of the reach and the impact they've had in their respective communities, both geographically focused, but as we saw, people in Hawaii and people in Egypt and people in Austin, Texas, I think the reach is far and wide. And so just being associated with these guys and the goodwill and reputation they've created for themselves, both as Boast to their customers, but again, with the Traction Conference and their own network, it's just really impressive. And so coming full circle in terms of how we met them, actually was through an extension of the Traction Conference. We probably for a different conversation, we have a program as part of Radian Capital where we invite people to be part of what we call our venture partner network, which is kind of people out in the world that have a lot of connectivity to interesting businesses, and where, especially when we were traveling a lot pre-COVID, when we might go to Vancouver or San Francisco or whatever it is, hosting drink events or dinners, things of the likes. So having people who could help, facilitate those events. We got to know Lloyd because one of my other partners was speaking on a panel in Toronto that I think was, if it wasn't directly related to Traction, it was maybe related to Mars. I forget exactly the genesis of the conference, but Lloyd was there. Lloyd met my partner, Ali. They hit it off. Ali thought he would be an awesome addition to our venture partner network. She introduced Lloyd to me, and Lloyd and I chatted. And I think we actually chatted twice. Really liked him. And probably it was like 10 minutes left in the second conversation. We're just talking about our program, talking about the world, what's happening in interesting tech companies and startups. I sort of just casually asked him, like, hey, what's Boast? Like, what do you do? And he started explaining what they did. And Lloyd's not a shy person for anyone who knows him, but he was like a little bit sheepish about it. Like, hey, it's not really it's not a venture-backed company. It's not something you might find that exciting. And started going into it, and I said, actually, this is amazing. Let's not talk about the venture partner network. Let's 100% talk about your company, Boast. And, a long process in which both sides really get to know each other. But it was probably somewhere between 6 and 9 months after that where we actually invested in the business.
And he was sheepish about that conversation because we weren't looking for capital. We didn't necessarily need it, but through that conversation, we soon realized that we can really accelerate our growth and put that capital to really good use. So I think that's why that conversation went a little bit wasn't really as forward as you would like, because we weren't looking for capital.
No, and by the way, pretty common in our world. Like, these are the types. Almost every time we've invested in a company, the first conversation usually goes something along the lines of, "We don't need capital," or "We're not looking for capital." And I always like to joke, kind of tongue in cheek, like, we're not looking to give out capital right now. Like, that's not how our business works either. We don't meet companies and give term sheets 3 days later. And so if that's what somebody's looking for, then Radian's probably not the right partner. Ours is really about, again, back to this concentration. Like, if we're going to be partners, whatever cliche, analogy you want to use, but if we're going to get married, if we're going to be partners in this thing, then, making sure it's a good fit on both sides actually is the most important thing. And I don't think enough companies, and not to give life lessons to people, on this conference call, but like, not enough people focus on that like, when you partner up with somebody, you really are partnering up for 5, 7, 10 years. And that's a pretty long time. And you want to make sure not only that the price is right and the terms are right, and it's fair for kind of all parties involved, but there really is that really nice, strong relationship and a bond on which you can build on to go through the good times and the bad times, because there will be both, no matter how great of a company you have.
Mm-hmm.
And to that conversation, Jordan, so our approach, the price and terms, they're important, and we sort of dealt with that, but we dealt with that towards the end of the process, not really at the beginning.
That's right.
It was the relationship, making sure that we're aligned. That was the most important part, and that was what we spent all our time on, basically, for a while, and just making sure that you understand the business and it is the right thing for you as well. And then we sort of dealt with terms at the end, but 90% of the process was really just making sure that is the right partnership.
Mm-hmm.
Totally agree.
And Alex, let's turn our attention to you. So Boast is effectively automating this, massive industry that's mired by consultants, financiers, and manual work. And of course, there's some massive accounting firms in that space as well. So maybe walk us through, your journey to starting the company, what led you to that decision, and then also what Boast is doing that's different.
Yeah, so it's a $200 billion industry, $200 billion industry, conservatively, sort of globally. So massive opportunity, and I kind of fell into R&D tax at a previous startup. So had a startup that didn't really work out. I learned about the R&D tax program, but I didn't really have enough knowledge to take full advantage of the opportunity and the program. And once that started to work out, I decided to go study accounting. My background being software engineering, and from that world, I kind of said, this R&D tax program is an engineering first program, part of the Tax Act, whether it's in the US or Canada or UK, Australia, whatever it may be. It's really an engineering first program that doesn't really fit with with accountants and tax lawyers. It should really be approached from an engineering first standpoint, and we saw the opportunity. I mean, it's a legacy industry. Most of the competitors in the space are accounting firms with manual processes. So there was a massive opportunity for automation and disruption, and that's the opportunity that we kind of seized on and wanted to solve. We started actually in Calgary because I spent about a couple of years doing my research on the markets and trying to figure out what's the most capital efficient place to start. And I was looking at competitors. I was looking at price sensitivity. I was looking at so the market opportunity that we could solve as a business, and so the size of it. And Calgary was the perfect place because everybody was really focused on oil and gas, and some of these legacy industries that, were massive opportunities, but technology was, starting, the tech ecosystem in Calgary was starting to form, and nobody was really focused on it, and adding value to that community, and we thought we could. So that's the reason we went to Calgary, is capital efficiency. So I guess the purpose of this webinar. But we started in Calgary because there was a market opportunity that was sizable. That we could add a ton of value to, and not many people were really focused on, because they had this other shiny object, so oil and gas, right? And it worked out really well for us. We went into that market, and Lloyd. So me and Lloyd, I told Lloyd when he joined me, I'm not going to be the face of this business, but you love doing this stuff. You love being out there, and you have the personality for it. It's an awesome fit. And he came in, and we made the community a priority, the community stronger, better, bigger, and that will be a win for our community, but will also be a win for us. Now we'll have a bigger market to address. So that's what we did. We started bar camp. We joined founders drinks, and startup, all types of small startup events. Eventually, we joined Startup Calgary, and really helped pull together some of those events into under one organization, and that really made a huge impact, and that helped us achieve our goals in the first year.
Alex, do you remember? I don't even know if I've heard the story. Do you remember who your first customer was, and how did you convince them? Because this is like, once you have the reputation, it's easy to get more customers in our world, but this is a pretty important decision for somebody to make. So did you beg, barter, and steal? How did you get the first customer, and what was that like?
Well, it's interesting because we had really strict criteria. So we started off saying, look, we have a goal, and the goal is, we need to sign 25 clients in the first year, and they need to have a certain average invoice amount, which was really important. So, and we're not going to discount what we offer. So we know we can offer sort of white glove service. At the time, it was very manual, but we know we can offer white glove service and do a great job, and we're not going to discount that. We're not going to discount the fact that we can do an awesome job and deliver great results. So it's really important for us to make sure that we find the right type of that we figure out our ideal customer profile, and make sure that we target that relentlessly. And honestly, I don't remember who our first customer was, because I think within the first 3 months we signed maybe 10 customers. We did really well, and we did that by making sure that we highlight our experience, highlight the fact that we can deliver, and not discounting price. So if the conversation turned to price, the conversation was always, look, we're not the cheapest guys on the block, but we are the best guys on the block. So ultimately, we will bring you more money. We will be cheaper than everybody else, and that was the conversation. That's how we started, and that was key, and that was kind of a struggle through the first few years of the business, because as you bring on additional sales AEs and sort of focus on sales, everybody's instinct is to sort of hit the quota and sign every client that comes along, because that's what makes us feel good, right? I want to sign every client that comes along as well. I want to add value and do a good job, and but we had to have really strict criteria to give us a margin to grow. So our net profit was our fuel to grow. So the farther we get into that, by providing discounts or falling outside of our target market, or ideal customer profile, then the less money we had to grow. So it was really important for us to really stick to that and be really stringent. And I got a lot of flack for that, from a lot of the team members early on. And I still think, looking back, it was the right thing to do, of course. And it's still the right thing to do now, today. Criteria can change and efficiencies change and so on. But you still need to have the same view. You still need to to understand what your economics are behind your delivery. Understand the capital required for product development, and really figure out what your ideal customer profile is. And of course, over time, like I kind of got to understand that, client lifetime value does matter. So churn matters. And, so your ideal customer profile does start to change a little bit. And early on, honestly, that kind of doesn't matter. If a client's going to be with you for 2 years, that's great. That's sort of fuel for 2 years. As long as it's a profitable client, it's great. But over time, it does matter to, you know, client lifetime does matter. Revenue churn matters, right? So you kind of start to refine that over time, right? But basically, that's your fuel for growth. Be very focused and make sure that you don't sway too much from that. And of course, we started the company saying community matters. Communities, let's add as much value to the community as we can. And the way we did that is one of the ways that we did that through our offering and our product was to say 10% of the clients that we sign can fall outside of our ideal customer profile. So we can help our friends, we can help our community, we can, and that was 10% of what we do. So, we help a ton of small companies, and that 10% of course grows over time. But that was our way of making sure that we still meet our growth targets and have the fuel to grow without external capital, but at the same time giving back to the community. So we kind of found a solution that worked for us, and we kind of settled on 10% because that's what made sense from a financial perspective. So.
And Alex, when you're talking about, customer acquisition and, you've obviously been covering a little bit as well about like finding those early customers and finding product market fit. Can you share with us, I mean, maybe the answer is community, but maybe share with us just like a few of the lean tactics that you might have used in those early days to drive customer acquisition and growth. Yeah.
So, community is a huge one. Get your message out there. If nobody understands that you can provide, an awesome solution to their problem, then they're going to look somewhere else, right? So get out there. So community is very, very important.
Can we double click on that for a second? Because not everyone has enough hours in the day to not only build a killer company, but also create an unbelievable marketing platform, conference, webinars and events that come with it. So what do you mean for somebody, the average person listening to this? Like, what does that mean? Get your message out there, and how did you really start on day one to build?
Yeah. So quite literally is do what works. So for us, day one. Pull together a list of your ideal customer profile for a certain target region and hit the phones, right? Let everybody know you're there and refine your message. So, A/B test the heck out of every call and, figure out what works and keep on doing more of what works and keep on testing, keep on refining that message, right? At the same time, if you are hitting those if you are calling and reaching those customers through email and so on, just selling your product is not going to work. You have to give them something, provide additional value. So, early on, we try to identify the, one thing that our target customer needs and has we can provide as free value to them. And we did that. So one was, education around R&D and what it is, like, who can take advantage of it. And a lot of larger enterprises and so on have access to this information and consultants, but a lot of smaller startups don't. So we said, let's provide that value. Let's make it all free. Let's package it nicely and, have it out there. And the other one was, community building. Everybody at the time in Calgary was looking for a place to network and find out the founders and learn from each other. And we said, why not just do this startup drinks and or bar camp, and that would be our value add when we reach out to prospects. So instead of telling them, hey, come and buy R&D tax from Boast, we said, hey, why don't you come join us at this event? It'll be great, and you'll get to network and learn from each other. So, so giving them something of value outside of your core, sales pitch is critical, and that's a way to get your message out there, right? That's a way to get your brand out there and get some brand recognition. And then the second piece of that, once you figured out, what works is brand rub, right? So try to partner with somebody that's better known than you are, and that doesn't have to be a giant enterprise. It can be just somebody better known than you in your local community, and try to get brand rub there, and try to see what value you can add to them, and in return, you're going to get that value from them. So those are key.
Yeah, thank you. And Jordan, great question to have Alex dive in a little bit further into that, because I know for many folks, marketing and building community and finding users is obviously an incredibly important part of the journey. So I really enjoyed kind of hearing more about that. But I want to switch change gears a little and move into fundraising. And Jordan, a question for you, which is, what are maybe some of the top 3 to 5 traits, of capital efficient companies that you're looking at to invest in? Like, what are those traits? What do they look like? Tell us more about that.
Yeah, and I just want to be clear as I answer this question. Like, I'm answering this from Radian's perspective. This doesn't make a good or bad bootstrap business, right? Like every founder's got their own path, and while we'd like to think all the best companies out there want their path to at least intersect with ours at some point, we kind of realize that my answer will be a bit idiosyncratic for us. We as Radian, we simultaneously look at both qualitative and quantitative metrics when we think about bootstrap businesses. The qualitative in some ways is probably more interesting. Quantitative, we can just talk about, understanding the unit economics, knowing that a company, like so many tech companies out there today are quote unquote growing very quickly, but they're also burning a lot of capital. So like, is that more or less impressive? Like, that's probably for the audience to decide for themselves. But what we got to understand, Alex has to understand his business. He has to understand the unit economics. He has to understand, somebody asked a question about, a little bit different, but if you're going to spend $1 on sales and marketing, what do you get for it? How does that translate into contribution margin and bottom line? In their case, very specifically, the thing I always remark is the most amazing thing. This company Boast, they have a little bit of upside down cash conversion dynamics, which is a fancy way for saying, like, when do they get paid? Most software businesses, when you sign a customer, you can get paid a quarter in advance or even up to a year in advance. And I've heard, companies paying for 3 years in advance if they can get the right discount, right? And so as a software business that has that kind of model, it's a lot easier to bootstrap. These guys had the opposite problem. They sign customers, they give them white glove service, they delight them, they work with them, they make sure they're successful. And then if and when that customer gets paid, which takes a long period of time, that's when these guys get paid. So we're just worth highlighting for a second, because there's no, again, one right model. And in this case, it just kind of blew me away. I've never seen a company with this sort of time lag between signing customers, spending money to get the customers, spending money to work with the customers, and then getting cash kind of way down the road, and still be able to bootstrap to the size they did and be growing at the size they were growing, which is really impressive. Anyway, circling back to the qualitative stuff. So when we founded Radian, we wrote for us kind of like our 6 maxims. We call them maxims, like our 6 maxims. Like, what would we look for in every business? And I think a lot of it's important to us, but I think a lot of it is applicable to kind of anyone starting a business. And so the first maxim we have, we say to ourselves, if the company had no revenue whatsoever, it just had the same product and the same cost structure, would that be a company worth owning? And it's kind of like, a very extreme way of saying, like, are there competitive advantages? Are there moats to the business? Are there things that are really hard to replicate that have value in and of themselves? And, I think the answer to this in this case was well beyond yes, right? So these guys, Alex can probably tell you the metrics, but if you look back 10 years ago, how he had to work with a company, how long it took him to work with a company, what their success rates were, if the company got audited on the tax side, how long that took, relative to where they are today, it's probably night and day. They have built up so much institutional knowledge, as well as a lot of technology underneath that institutional knowledge, which means that for every one of what they call their TPMs, people that actually front face to the customer, every single one of them can now deal with more customers than anyone else basically on the planet, can move those customers through more quickly and more seamlessly while still delivering a great experience, and has higher success rates and actually getting people through the process to get their shred credits, or down in the US, R&D tax credits, or whatever it is, whatever type of tax credits we're talking about. And that is really hard to replicate. Like, me and a bunch of smart developers in Silicon Valley with $100 million, like, we could build some pretty cool things, but it would take us a long time to catch up to what these guys have built. And to us, like, that's just an interesting asset test. Like, that is a business in and of itself that's really interesting, as opposed to some companies, not picking on any, but like, just because your revenue is growing doesn't mean you have a long-term sustainable asset appreciating business model. And so again, that's just kind of one of the many questions we ask. We ask questions about the quality of the team. We ask questions about how receptive the industry is in terms of tailwinds to allow you to get more lucky than not. We actually ask a question which is very unique, I think, in 2021 for tech companies. But if a company had to trade on cash multiples, not revenue multiples, like, what would happen? Like, would that be okay? Or, if we pay 20 times revenue multiples for a company burning a lot of money, like, could that company ever be profitable? And again, the public markets don't seem to care very much today, but we're not sure. We're not sure that's the right way to think about it indefinitely. So just a bunch of flavors of questions we ask. I don't think, last thing I'll say is probably too long-winded, but I don't think we look at bootstrap companies differently than, companies that have raised a lot of money in the sense of the quality of the business we'd like to see. What we understand fundamentally is they are trading off growth for, profitability and more ownership in their own business. And that's a trade-off that we can always understand, because if Alex understands the levers of the business, and I turn around and give them 10 or 20 or $30 million, and I know what the implications are going to be because the machinery really works, then I know, like, hey, we could grow much faster. They were growing very fast in their case to begin with. But even if you're a bootstrap company not growing nearly as fast, if you can sort of prove that by pouring fuel on the fire, it's not just wasting money, it actually has implications. $1 in is $4 out, or whatever the formula is. Then I think we get very comfortable versus just saying, oh, headline growth isn't 100% today or 50% today or whatever the metric is. And therefore it's not interesting. Like, totally different when you're looking at a bootstrap company.
Mm-hmm. And then Alex, on the founder side of that, piece of it, how have you managed to, like, fund the business while preserving your equity for so long? I know that that's probably a question that is going to come up from a lot of folks. And so maybe just talk a little bit about that.
Yeah, so I'm looking at the chat here, and a lot of guys asking, like, how much you spend,
Me too.
sales and marketing. And first year there was nothing. It was just founder sweat equity until we had the cash flow. We had the cash flow to start hiring, and the first hire was sales, and then sort of on the CS side. But honestly, and over the years, I've always had this question, and every time I give an answer, some founders think I'm a little bit silly, but it was really, we didn't make any hire that didn't touch revenue. So what I mean by that is, it didn't bring in a client, it didn't help a client, deliver the outcome to a client, then we didn't hire it. So all basically our organization was a bunch of guys that touched clients, like, constantly. That was our job. So if the job function didn't interact with the client, then or perform sort of the output to a client, then we didn't have it on. So and I think it was the right approach for us, because it really helped us sort of maximize our net margins and really help us fuel that growth. But it does cause some headaches down the line when you have to start filling in gaps. But it really did help us have enough cash generated by the business to grow. So it also kind of leaves a lot of it does definitely make the founders jack of all trades a little bit, and not everything will get done perfectly, but just understand what needs to be done perfectly for you to be successful. And usually, not everything needs to be perfect. For us, it was obviously the way that we the output that we perform for our clients had to be perfect, and our community and team needed to be happy and perfect. So those are the things we focused on, and then everything else when it came to our finance team and everything else that we needed. We added that later on, much later.
I like this question. Maybe weave it in. Somebody just wrote, like, how complete was your MVP when you started Sales Push? Now, you guys are a little bit different because your product in the early days was more service oriented than tech, but just curious, like, you have a point of view on that? Like, when is it appropriate to start talking to customers? When is it the right time to, when is it selling out, just the right amount over your skis and not too far over your skis when it comes to actually dialoguing with customers?
Yeah. Well, I think you should do it, as early as you can, but you should do it as early as you're confident that you can deliver value, right? So if you can deliver value, then go talk to customers, go try to deliver that value and see if the customers are willing to pay a premium for it. And don't discount it, right? If you're confident in delivering that value, don't discount, right?
Mm-hmm. Yeah. And Alex, I know you were chatting a little bit about, obviously being a bit more bootstrapped and then moving into this raise. And you had, a huge round recently, $123 million US, both equity and debt. You raised this during the pandemic, which I'm sure is no small feat. So maybe talk a little bit about, why now? Why was it the right time to raise? And maybe talk a little bit about the planning, prep, timeline. Like, take us behind the scenes on that, and be sure to also touch on, like, was it challenging to do all of that in the middle of this global pandemic we're all in?
Well, what's interesting, this global pandemic really has changed life quite significantly, because I also had a baby as we went
Congratulations.
into lockdown. So life has been quite interesting, in very positive ways. Not just what we all have to go through, but in very positive ways. Personally, has been awesome. Raising capital, pandemic or not, it's all the same. I think it's definitely harder to figure out whether your partner is aligned and is the person you want to work with, and it's just a little bit more challenging because you can't have those drinks in person. But it's not impossible, right? I mean, put in the time and have those calls. I mean, Jordan and Chris were on endless calls with us through a process, and it was two ways. It wasn't a pull from them, but it was from us as well, right? It's so trying to get to know each other, trying to make sure that it's the right fit. So, pandemic or not, I don't think the fundraising process is really any different. We have a lot of friends that have successfully raised capital through the pandemic, and the outcome is always, so the feedback is always the same, right? It doesn't make a difference. Be adaptable. If you can't adapt to this, this is probably not the largest challenge you're going to face, I hope. So fundraising, through the pandemic should be the same as fundraising when it's not a pandemic. Right?
Mm-hmm.
Use technology and get to know each other, right?
Yeah.
And
I'm happy to answer that a little bit too, because obviously I've seen more of it from this side. First of all, I think what Alex said is exactly right. I think both sides are always simultaneously buying and selling. That is a good process. If you feel like you're always on the defensive and you're not in a position, whether you're talking to small seed investors or large investors, it doesn't matter. Like, both sides should kind of understand this is about teams coming together. And so yeah, I think that approach where, yes, there's a lot of things I need to know and understand about their business and extract from them and get a sense for Alex, get a sense for Lloyd, get a sense for how they work together. But they also need to do the same thing for us. Like I keep saying, the best companies I've been involved with, they always have challenges. There's no such thing as easy as it looks. And the media tries to make it look very easy these days. Like, as easy as it looks, it never is that easy. It's a very volatile experience. And so you want to know you're kind of in the trenches with the right people. And so, advice to an entrepreneur: anytime, if you were ever to go through a process and you didn't feel like you got what you needed from the other side, that it was all one directional, like, that is not a very clean process. That's not a good process. And I would think twice about working with those folks. I think we used to get on airplanes on a Monday because it was a Monday, right? Like, we used to travel all the time. So my dog and my wife and my kids, I think my wife and my kids are happy I'm home. My dog's really happy I'm home. It has been different. It's definitely been a change, whereas, you could be in a room with a team and it's important what people are saying. It's equally important, like, all the nonverbal cues, people may not realize we're noticing, but like CEOs talking or CRO, chief revenue officers talking, and you look down the way and the, chief technology officers rolling their eyes. Like, there's just times where you can see some stuff where you kind of get a better feel. And, almost all the time we would have taken these guys out to a bunch of dinners and just spent a lot more time in person, which I always think is nice, but such is life. But coming down to this experience, this wasn't the only deal we did in 2020. So we have done some deals over more Zoom than not. Although in this case, we had met Lloyd in person in the past. Actually, some members of our team, I couldn't join, but some members of our team got together with these guys in Seattle. So it wasn't as if we didn't get together a little bit, but certainly not as much as we would have. As Alex said, we replicated with a lot of Zoom time. I remember we would literally have dedicated time where we say, we're not going to talk about either of our businesses. We're just going to have, beers or drinks or whatever it is. And I remember sitting from 9 to midnight on the East Coast time, just hanging out with these guys and saying talking about life, talking about their families, talking about the hobbies and interests they have. So all of that is still really important. And luckily we have enough communication mediums and technology today that we can kind of make it work from sitting in our living rooms. So,
and there's a question in the chat that I want to just jump into real quick. It says, did Radian lead the round with Boast? And the follow-on question was, where did you source small VC? So I'm not sure if you.
Radian was the round with Boast.
Yeah, we don't yeah, it's a little bit of a distinction between being a venture capitalist or not. We don't have club rounds. We don't need input from other people. We have co-invested with some other groups, but for the most part, we feel like we work very hard for our companies and we don't need people coming along for a free ride. So if we're with a group that brings something very unique and something balanced to what we bring, then we're always happy to work with them. But it's usually us. I think the confusion here, because now that person's asking about the 123 million. So 23 million was us and 100 million was a group called Radian Capital. And Alex can go into detail on it, but that capital very specifically was used or is being used to create products where we can actually help finance our customers in advance of you actually getting paid or refunded the tax credits. So if a company submits and they know, these guys know that it's a foregone conclusion that the Canadian government is going to pay $500,000 or whatever the number is, make it up. Why not give that company the $500,000 either in kind of installments or a lump sum payment up front, and then have them pay it back if and when they sort of get paid by the government. So a lot of the capital is used for that. But
yeah, our goal is to accelerate the cash generated by R&D activities and to do it quickly, painlessly, and with high compliance. So, we want to help companies in North America stay competitive in a global market. And part of doing that is making them, helping them accelerate their R&D spend. And basically, we want to go to market with, one offering, work with us, and get your money now. And we take care of the risk and everything else that goes along with it. So, and that's what we're doing with 100 million, and we can extend that to 500 million. So, we've been so fortunate enough that our numbers and success and the way we deliver is very robust, that we have access to this capital, and we're starting with the Canadian market, and soon we'll be in the US market with it as well. But it's an awesome opportunity to really help the community, and again, each community where we work and live, because we have teams all over. It's an awesome way to help them, help the communities and get stronger and accelerate on this.
I like this question for you too, Alex. I'll ask it. I'm gonna also add to it. So somebody asked, where are you investing the growth from here? I always like asking the question, having been so lean and bootstrapped, what are sort of the forces and tensions you wrestle with yourself about now that we've given you capital and telling you to go spend it? How do you see that all coming together?
Well, the nice thing is, Jordan, thanks for not putting any pressure to spend it. We haven't spent a penny of it, so that's good and bad. The challenge is really filling in the gaps and struggling with the fact that we have to spend money in areas that will drive the business forward, in 6 months, in 12 months, but may not have a direct revenue impact today. In the past, that was the litmus test. Do we spend money? Is it going to impact revenue right now? And now, so the mentality and the way we look at things has to change and shift. We're really trying to set ourselves up to do that, 300%, 400%, 500% growth. and that requires a really robust and strong foundation. And we're filling in those gaps now. So spending that money to fill in those gaps is kind of the challenge and the struggle. And really, we've never brought in executive help from the outside, and that's what we're trying to do now. We're looking for a CTO for and a few other roles, and those are challenging roles to fill when you don't have the experience. So thankfully, Jordan and the Radian team have been super helpful on that side. And it's awesome to have that experience on our end without having to pay an arm and a leg for it. Again, so the bootstrap mentality coming in, but it's nice to have that experience and basically have it in a friend rather than a contractor, right? And that's what we've been struggling with, is filling those gaps and really spending money in things that won't necessarily have a revenue impact today.
I really like it. Somebody keeps writing me like lessons of what you're saying, and they're pretty funny actually. Yeah. So this one, fix your foundation before adding more floors. I think that I think that's very true. You can't I told Alex when we first invested. Usually, so sometimes we invest in companies that aren't totally bootstrapped. They're just more lightly capitalized. Maybe a different story, but on the bootstrap businesses, one of two things is always inevitably true. Like a CEO either gets the money and literally tries to spend it in like 60 days, and we have to like whoa, relax, or they're very cautious, and ultimately, I think, as Alex said jokingly, like you got to find the happy medium of both. You got to get comfortable and break yourself from the bootstrap mold if you're very cautious about it. It's not funny, like it really is a challenge we deal with sometimes, where a CEO like hasn't spent any money in 6 years. We give them some money and we call them back up like a week later, and they got vending machines for free, and they're doing all kinds of crazy stuff, and we're like, we gotta figure this out. But finding that balance, I think, is important, but makes sense. And then this whole point about, like when you're bootstrapped, you're fundamentally, in almost all cases, you're fundamentally making trade-offs about your business. So now, if you want to accelerate growth, you want to go after new markets, new products. I think Alex is exactly right. You start filling in the cracks and laying the foundation to make sure. This analogy about building more floors, you actually have the foundation, the chassis on which you can build on, and I think that's really important.
Mm-hmm.
But a word of caution: building that foundation while you're trying to bootstrap, probably not the right way to go, because you would run out of cash.
Totally. That's exactly right.
I do hope Jordan is who shares Alex's last name. I do hope, Jordan, you are tweeting these or sharing these lessons somewhere, because it would be great to have them afterward. Maybe we'll download the chat and it'll become a little bit of the show notes.
He had one before. I think it was like, sell shit before you build shit. I'm not sure that's exactly what Alex said, but
that's not really what I said.
No. still made me laugh.
So we have a couple minutes before we're going to open up for some Q&A. And I just want to ask this question to both of you. When you look back sort of at your full journey, what do you wish you did more of, and what do you wish you did less of?
I wish I, maybe found a balance between, hiring certain team members, quicker, rather than sort of pushing on efficiency. So, maybe being a little bit less stringent on the efficiency side. I think that would have helped, and I think it would have eventually gotten us a little bit further. So there's a fine line between sort of net profit margin that fuels your growth and balancing that as you move along each month, and hiring quicker. So I think I would have spent a lot more time on that. Not that I didn't, but maybe I would have been a bit less conservative, and less of. Maybe spend less time trying to change personalities. So, as we hired on the team through the years, we can fix anything except personality, right? And sometimes it's just not a personality fit, and you can end up with both sides being unhappy and both sides trying to change. And it's kind of like any other relationship, right? You're not going to change your personality, so don't even try. It's just easier not to try.
And Jordan, what about you?
I like that one. I'm not gonna have to. I can't steal it here, but I'll steal it for a future one. Impress yourself. Don't worry about impressing others. Don't be afraid to take some risks within reason. I think hopefully most people on this call if they're already doing some entrepreneurial things, they're taking more risks than I did for a lot of my career. So don't be afraid to fail. I think that's an important one. And then generally, like, people say it jokingly, but I've come to live it more and more. Like, just spend time with people you like. Back to this point, I love their business, but if I didn't think Lloyd and Alex were awesome people that I really could bond with and could build something special with, like, we wouldn't have done it. And that will mean lots of things to lots of people, but life's too short. Just surround yourself with great people, and if and when you find yourself in a situation where that's not really the case, like, press the eject button and don't be afraid to do it quickly.
Yeah, I think that's great life advice. Beyond business, it's applicable everywhere. Okay, so we've got a few minutes to do some questions. I'm going to go to this one first, which is, I'm assuming this one's definitely more for Alex, but definitely both chime in with your thoughts. How did you manage the transition from services-based to software-based, and then what was the tipping point that created scalability for you?
Yeah, our goal was always to automate and provide software to help with the process. So from day one, we looked to find a very efficient process to deliver at scale, and we looked to automate that process using technology. We didn't necessarily have build proprietary technology right off the bat. We've actually very early on, we did build our own proprietary technology on top of somebody else's platform, which did really help us and help us find efficiencies in the business before we moved on to full-fledged Boast.AI platform. So we always had that goal in mind. So it's not really a super tough transition as long as you have that goal in mind. But the hard part for a business like this is if you do end up with a site that is technical based, product based, and a site that is more a little bit more consulting services, making sure that you keep both sides happy and you don't make the one side feel like second class citizen is super important, because you need both sides to succeed, as you go through your journey. So just make sure that everybody feels special and feels the way they get treated, the way that they provide value to a business, right?
Mm-hmm. Yeah. And Jordan, anything to add to that one?
Not really. I think that's a pretty good answer. Yeah.
Perfect. Okay, let's go to another one, which is, again, open floor question. How long would you bootstrap before you give up?
Give up, like raise money, or give up, like quit?
Yeah, that's actually a good clarifying question. So maybe the person who asked it could clarify
Well, the interesting part is my previous business. It was online recruiting, for the high turnover industry, and I did that for a year and a half. Won great clients over, and we had some 30 of the largest clients in Canada, like Care Group and Winners and whatever. I couldn't figure out a way to monetize them in a way that actually made sense and provided enough value, and I gave it up. So it took me a year and a half to figure out that my economics were all wrong, and I needed to move on. So I was in a highly competitive industry. Price was just being driven downwards, and everything looked wrong about it. So that's when I started accounting. I wanted to learn that world a little bit better, since I had such a big miss at the beginning. But second time around, I really focused on the economics really early on, and there was no reason to give up, because the focus was on efficiency, on new customer acquisition, and there's lots of time for A/B testing and and figuring out, exhausting all channels. As long as the economics make sense, you will have some cash flow to be able to exhaust those channels, right? So that answer is tough, right? I mean, if you can't find your economics and you can't find external investors for the same reason, probably, then maybe it's time to move on, or really think about it differently, right?
Mm-hmm.
Yeah, I think that's right. I mean, just adding quickly, your journey, so only you can really answer that question, whoever asked it, and people think it in general. I'd say being self-reflective in a way where you can really understand why the business is not taking off, I think is really important, right? And there can be a whole host of reasons why that's the case. And some of those reasons are overcomable. Is that a word? Can be overcome. Yeah, I'll say that can be overcome. And some can't. I mean, like Alex said, some are structural issues. And that doesn't mean the 10,000 foot vision of the business is flawed, but maybe there's something in the micro that's flawed and it allows you to fix it and keep going, or, I hate the word give up, but give up. So I think it's very much a personal question. But if you can, if you can take an honest, unbiased, it won't be unbiased, but as much an honest, unbiased look as you can at the business and really reflect over a period of time, if it's been 3 months, 6 months, it's been 5 years, whatever it's been, to be able to actually look back at where there's been successes and failures, and where there are failures, like, again, that which can be kind of broken through, and certain issues which are just kind of structural impediments that would be very hard, if not impossible, to move, I think would very much influence how I thought about the decision, personally, myself.
Mm-hmm.
And it's not give up. It's a pivot, right?
But do something else.
Learn and move on, right?
You learn more from your failures than you do the successes. That's 100% true. So.
Yeah. And I want to make sure we answer this question, which is, do you recommend any non-dilutive sources of financing? And if so, what options are there?
We're talking about R&D tax here, right? That's a great way to go.
I love that one up.
Yeah. No, but there are a ton of other grant programs available as well. They tend to be more biased, and they have government representatives to help you through that process. There are lots of them in the U.S. and Canada, that for sure you should go with non-dilutive source of financing if you can. It's a lot cheaper. You can do revenue financing. There are lots of options. If you are bankable, then the rates and what you can get that non-dilutive financing at is fantastic. Part of our journey was making sure that we get bankable as quickly as possible. So, in Canada, we went with BDC because they were willing to take more risk and give us some history so that we can become bankable quickly and get really nice lines of credit at very cheap rates. That's one way to go, is just you think a little bit ahead and get that 1 year history with BDC or whatever it is, as a lender that's willing to take more risk, that will build up that credit, make you bankable, right? So definitely take advantage of that.
Mm-hmm.
Yeah. Go for it.
I was just going to say, do you want to tie any of that into sort of the funding that you just secured and what that sort of means for the ecosystem as well?
Absolutely. We have $100 million to make sure we can accelerate your R&D costs. So if you do have R&D spend, this is a great way to make sure that every quarter worth of spend you can increase by 75% the next quarter, right? That's the easiest way to do it.
Mm-hmm. Awesome. And Jordan, I interrupted you last time. Did you want to?
No. I think it's a better way to end. Just we'll give the infomercial for 30 seconds, like amazing products. So no, I think if that question too is based on like debt versus equity, all I'd say about that is nothing's free, right? Tax credits aside, which actually come pretty close. I guess it takes time and effort. That's about the cost. Debt and equity is always a trade-off. For certain businesses, it's absolutely right to go the debt route. For other businesses, it's not as apparent. And when you think about the cost of capital, there's there's a quantitative number on a page, but then there's all the existential things that come around the dollars you take. And not to end on an infomercial for us, but like hopefully the Boast guys would say, when we give capital in most cases to companies that don't need it, they have to fundamentally believe that the trajectory of the business or the pot of gold of the rainbow is going to be bigger or different, respectfully, for having worked with us. And if we can't make that case, then we're not doing our job. And so while I would never deny that equity capital can be expensive, hopefully, us or anyone else, if you find the right firm for you, there's a lot more that comes with it than just the dollars and just the cost. And same thing for the debt. Like sometimes debt providers can be helpful, sometimes not. Sometimes they can want to be partners, sometimes not. You just got to be very careful when you're trying to quantify like what debt's actually costing you or capital in general is costing you in a more holistic equation.
Yeah, and I think we can we can wrap up on Jordan's lesson number 8. There's no free lunch, but learn where to get an inexpensive sandwich. So, I
Great.
think that's a great place to end today's session. I just want to quickly say thank you so much, Jordan and Alex, for sharing your insights and sort of bringing all of your knowledge to the community. There's so many questions that we didn't get a chance to answer. I really appreciate everybody for posting them. If anyone, I don't know if you're on social, if people could follow up with you there, or if there's a means for them to do that, but maybe I'll let you just quickly say if there is a preferred way to get in touch with both of you.
I'm on LinkedIn, or you can go to radiancapital.com, our website. We have an email link. So either way,
Perfect.
I'll try to get back to as many of you as I can.
And Alex, what about for you?
Boast.AI, LinkedIn, and Lloyd Lobo is always available. So if you just Google that name, you'll find him. No problem.
Perfect. And someone's
Call his cell a bunch, see, just keep calling him until he answers.
Yeah.
Amazing. Thank you so much, everyone, and have a great day.
I need some traction.